Hi, everyone, and welcome back to Freedom Finance Mindset. My name is Mike. Before we get started, a quick but important note. This video is for educational purposes only. It is not personalized financial advice. Investing always carries risk of loss. What you hear today may not be suitable for your specific situation. Please do your own research or speak with a qualified financial professional before making any decisions, okay? Now, if you're watching this and you're somewhere between 45 and 64, I want you to know something important. You've worked hard for a long time. You've raised families, paid mortgages, built careers, and put money away when you could. And now you're thinking it might be time to make that money work harder. Whether that's growing your retirement nest egg, keeping up with rising costs, or leaving something meaningful behind. So you open YouTube. You type in "How to Invest for Retirement" or "Best Way to Grow Savings After 45." And suddenly, you're hit with three completely different worlds. One video tells you stocks are the safest, most proven path. Another says crypto is the future, and you need to get in before it's too late. And then there's the one promising that Forex trading can give you financial freedom from your laptop, trading currencies while you travel or enjoy retirement. They all sound like they have the answers, and they all have people showing big numbers. But here's what most people your age discover the hard way. Jumping between all three usually leads to confusion, stress, and sometimes losing money you really can't afford to lose at this stage of life. The real question isn't which market makes the most money the fastest. The smarter question is, which one helps me build real, lasting wealth while protecting what I've already worked so hard to build, and actually teaches me skills I can use for the rest of my life? Because when you're in your 40s, 50s, or 60s, you don't have decades to recover from a big mistake the way someone in their 20s or 30s might. Time is more valuable now. Peace of mind matters more now. And that's exactly why the order you learn these markets makes such a difference. Before we dive deeper, let us know in the comments where you're watching from. We'd love to hear from you. And don't forget to hit that subscribe button so you never miss any of our upcoming videos. All right. Let's break this down simply and honestly, starting with the market that teaches the best habits first. When you buy a stock, you're buying a small piece of a real company. Companies like Johnson & Johnson, Procter & Gamble, or the big American businesses that power our economy. Over long periods of time, as those companies grow and the economy expands, the value of those shares has historically risen. The S&P 500, which tracks the 500 largest U.S. companies, has delivered an average return of around 10% per year over many decades. That includes the good years and the tough ones, like 2008 or early 2020. Now, markets go up and down. Nobody can predict every move. But for people building wealth steadily, the power of compounding turns consistent investing into something meaningful over time. Many families who built real wealth didn't day trade. They invested in productive companies and let time do the heavy lifting. Here's what that looks like in real numbers. If someone invests $500 a month into a diversified stock index fund averaging around 8% annually, after 10 years they'd have roughly $91,000. Not overnight riches, but real momentum. And if you have a bit more time, say 15 years, at a more conservative 7%, even $400 a month can grow to around $127,000. That's the kind of progress that actually moves the needle on retirement or legacy goals. Now let's talk about crypto. Crypto is very different. You're not buying ownership in a company with earnings and assets. You're buying a digital asset. Bitcoin went from less than $1 in its early days to trading at very high levels at times, one of the biggest asset increases in history. That kind of movement creates excitement and, for some people, life-changing gains. But here's the other side. Crypto has also experienced drops of 70% or more multiple times. It's extremely volatile. For someone in their 50s or 60s who needs their money to be there when they need it, putting a large portion into something this unpredictable can create a lot of stress. It's closer to venture capital than traditional investing. High potential reward, but also the real possibility of significant loss. Most people in your situation do better treating it as a small, optional part of the portfolio rather than the foundation. Then there's Forex, the foreign exchange market where currencies are traded. It's the largest financial market in the world, but for retail traders, it usually involves leverage. That means you can control a large position with a relatively small amount of your own money. Sounds powerful, but it magnifies losses just as fast as gains. Broker reports and studies consistently show that 70 to 80% or more of retail Forex traders lose money. Not because the market is rigged, but because the combination of leverage, speed, and emotion is extremely difficult for beginners to navigate successfully, especially when you're trying to protect and grow money you've spent decades building. So we have three options, all with potential, but the order you learn them matters enormously. The best place for most people starting or restarting in their 40s, 50s, or 60s is the stock market through simple, long-term investing. Not because it's the most exciting, because it naturally teaches the habits that actually build wealth. Patience, thinking in years instead of days, focusing on value over hype, and understanding that time in the market beats timing the market. Think of it like this. Learning to invest through broad stock index funds is like learning to drive on familiar roads in a reliable, well-maintained car. You build confidence. You understand the rules. You develop good habits safely. Jumping straight into leveraged Forex or high-volatility crypto is more like getting behind the wheel of a high-performance race car on a track you've never driven. It's possible for some people, but the risk of an expensive crash is much higher when you haven't built the foundation first. Once you understand long-term stock investing, everything else becomes easier to evaluate. You already know how to think about risk. You understand market cycles. You know the difference between price and value. Those skills transfer to any other market you might explore later. So what does this look like in practice for someone watching right now? Here's a simple, practical path I recommend for most people in the 45-64 range. First, focus on broad, low-cost stock index funds or ETFs. Think total U.S. stock market funds or S&P 500 funds. You can do this inside a 401k at work, especially if there's a match, or in an IRA or regular brokerage account through companies like Vanguard, Fidelity, or Charles Schwab. Keep costs low. That's one of the few things you can control. Second, invest consistently. Set up automatic contributions every month, even if it's just a few $100s. This is called dollar cost averaging, and it removes the stress of trying to time the market. Third, keep it simple at the beginning. Many people in your situation do well with a target date fund that automatically becomes more conservative as you get closer to retirement. Or a simple 60-40 or 70-30 mix of stocks and bonds, depending on your comfort level and timeline. Fourth, only after you have an emergency fund in place, high-interest debt paid down, and you're comfortable with the basics, consider whether a small allocation to crypto makes sense for you, and I mean small, often 5% or less of your investable money for most people at this stage. And Forex? For the vast majority of people building long-term wealth, it's better left alone or approached only after you've developed serious risk management skills and treat it like a business, not a side hobby. Let me give you two quick scenarios so you can see the difference. Imagine Linda, 53, from the Midwest. She saw the crypto headlines and put a meaningful portion of her savings into a few coins in 2021. When prices dropped sharply, the stress affected her sleep and her marriage. She eventually sold near the bottom because she needed the money for her daughter's wedding. It wasn't just financial, it was emotional. Now imagine Tom and Lisa, 58, who decided to keep it simple. They maxed what they could in their 401k skes with low-cost index funds, added a bit extra to IRAs each month, and ignored the daily noise. 5 years later, their portfolio has grown steadily. They still watch the market, but they don't lose sleep over it. They have more time for their grandkids and each other. The difference wasn't luck. It was starting with the right foundation. Look, markets will change. New trends will appear. Crypto and Forex aren't going away. But the fundamentals of long-term investing, patience, diversification, controlling what you can control, and letting compounding work, those principles have stood the test of time across generations. If you're just starting or getting serious again, begin with stocks and long-term investing. Build that foundation. Get comfortable. Then, if you want, explore other areas with clear eyes and only money you can truly afford to have fluctuate. You've already done the hardest part, showing up and wanting to learn. Now it's about moving forward with clarity instead of confusion. If this video helped bring some order to the noise, I'd really appreciate it if you give it a thumbs up and share it with someone else who might be feeling the same way. Drop a comment below and let me know what your biggest question or concern is about getting started with investing right now. I read as many as I can. Thank you so much for spending this time with me. I'm Mike with Freedom Finance Mindset, and I'll see you in the next one. Take care and keep building that future you're proud of.